To buy or not to buy? That is the question investors wrestle with as we watch the daily price movements of our favorite stocks. And let's be honest, buying really is the best part. Every buy brings a new wave of excitement and hope. It's exhilarating. There is always a second question, though, nagging us every time, right before we press the buy button. That question is this a good price? Welcome to the Quality Investor. Today, I hope to aid in finding that fair price for a group of stocks that I believe have some of the best long-term growth potential in the world. I own a lot of these stocks, but there are also a couple that I would love to own. I think it is important, though, to have an anchor in your mind about what you're willing to pay for a stock before buying it. It helps in preventing impulse buys and overpaying for a business. And it forces you to have that ultimate virtue in investing, patience. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Each of these buy prices are based on my own DCF models. Those that regularly watch my videos already know, but I find a buy price based on 3 DCF models: a bear case, a base case, and a bull case. If the business pays a dividend, I run a dividend discount model, a bear, base, and bull case there, to add an additional data point to my buy price. And lastly, I run an exit multiple comparison against the business's competitors based on PE ratio. I find the average or median PE of their competitors and apply that to the earnings of the business I'm valuing. For each case, bear, base, and bull, I apply a weight to each model to find a weighted average price. So for the base case, I apply a 50% weight to the DCF model and 25% each to the dividend and exit multiple models. Once I do that for all 3 models, I apply a 50% weight to the base case buy price and 25% weight to the buy price for the bear and bull cases. And once all of that is complete, I have an initial buy price. But there is more. I use a margin of safety to discount the buy price even further. The margin of safety accounts for any forecasting errors in the model. And believe me, your forecasts will rarely align with reality. I use a different margin of safety for each business depending on my own risk assessment of that business. It will all make sense as I go through the list today, and I'll also show a buy price summary of one of the stocks so you can visualize the calculation method I just discussed. So, without further ado, let's dive in. The S&P 500 took a bit of a nosedive heading into this weekend. After being flat for most of the week, it fell almost 2% on Friday. And this is a bit of a microcosm of how the entire year has been so far for the S&P 500. The S&P 500 is up only 2.5% on the year, and to even get to that 2.5%, it's been a pretty rocky ride. All of this is to say that even with Friday's fall and a relatively flat start to the year, it does seem like the S&P 500 is pretty expensive. And we are seeing a lot of prognostications calling for a correction, shall we say, in the stock market in 2025. And the way this relates to some of the buy prices I'm about to show you is that I still believe there's a lot of stocks in this market that are trading quite high. Finding good deals in this market is becoming tougher and tougher. However, so long as these businesses keep posting very strong earnings and keep increasing their cash flows, the returns will come. This is my buy price for some various stocks, some of which I own. The 3 highlighted stocks here I do not own, and these are all stocks I really want to own. However, as you'll see in a second, I think their price is still a little bit high in the market. Here we have the market cap for each of these stocks, as well as the margin of safety I use. I said that I use a different margin of safety for each business, the current trading price of that stock, the buy price, or the price at which I would be willing to buy more shares of a stock, and then how far it would have to fall before I buy it, or what kind of wiggle room I have before I will not buy it. The largest market cap on this list, and the first on this list, is Apple. I use a 15% margin of safety with Apple. I used to use a 10% margin of safety with Apple, but given their slowdown in growth. Now, 2% revenue growth annually in the past 1 and 3 years for Apple, and the fact that their free cash flow has slowed down quite a bit, and the fact that there really isn't a very exciting roadmap of product releases for Apple, I don't think they're as safe as they've once been. So at a $245 share price, I think they're trading very high right now, and my buy price for them would be $190. They would have to come down nearly 23% in price before I even consider buying more. Check out the video I did on Apple for a more in-depth discussion there. Microsoft is next on the list. I have a 10% margin of safety on Microsoft. They're an incredibly safe business, very well diversified. They have an incredibly wide moat when it comes to Office applications and operating systems, as well as being the second largest cloud data provider in the world with Azure. Right now they're trading at $408. They came down recently post earnings, and I have a buy price for Microsoft at $415. There's a tiny bit of wiggle room with Microsoft there, just over a 1.5% difference between the buy price and the current share price, but it seems like it won't be long before Microsoft is out of my buy territory again. Amazon. Number 3 on the list, I have a 20% margin of safety for Amazon. As much as I love the Amazon business and the fact they dominate online retail, they have an incredibly volatile free cash flow. And this is due to Amazon's seemingly reckless abandon when it comes to large capital investments in the business. These investments have paid off for Amazon very handsomely, but it does create for very volatile free cash flow. They're trading at $216.58 after a pretty large pullback on Friday. I have a buy price of $230. They're number 1 in the world in cloud data providers with AWS, and with a 6% difference from my buy price and the current price, they can grow 5% more in shares, and I'd still be willing to add to them. Google is number 4 here. Again, a 20% margin of safety. There's a little bit of existential risk with Google going on right now, given some investigations that they're under. They're also the 3rd largest cloud data provider with Google Cloud Platform. But Google is a holding I very much enjoy having. They are the 2nd largest in my portfolio. And right now, I think they have a buy price of $200. For some reason, the market does not want to send Google past $200 a share. And all the better for us, because right now I think they're one of the best values in the market. They have 11.3% wiggle room for my buy price. They're now a dividend growth stock, and they just have an incredible long runway of growth given the diversified nature of their business with search, data centers, and then of course YouTube. Next we have Visa. Visa to me is a picture perfect business. A 10% margin of safety. They're incredibly safe. They grow like 10% per year like clockwork. However, they are also very high in the market, $348 a share. My buy price with Visa is at $295. And the biggest reason here is they just don't grow their free cash flow fast enough to justify their current share price. So they would have to come down about 15% before I'd be willing to buy more. Intuit is the newest holding in my portfolio. I started adding to Intuit when it came down to under $600. And I will continue to add more so long as it is under $600. I have a 20% margin of safety with Intuit. Check out the video I did for my in-depth analysis on their business and their future growth projections. And for some reason, the market does not like Intuit right now. They're at $565 per share right now, but I will gladly add more to my Intuit position. I want to make it a larger holding within my portfolio. So I'm going to be continually adding to this position, probably more than any of the others on this list. And on that note, I do want to share with you my buy price summary for Intuit so you can visualize all of those calculations I was talking about earlier. This is the valuation summary for Intuit. You can see I have my bear, base, and bull cases, and then the 3 models that I use: discounted cash flow, the dividend discount, and the exit multiple. Just focusing on the DCF for a second, my bear case DCF for Intuit is at $535.44. This assumes, by the way, a free cash flow margin of 27.7% by year 10. The current free cash flow margin is at 31.4. Base case is at $691.57, assumes the same free cash flow margin by year 10 that they have today. And the bull case is $891.38 with a 35% free cash flow margin by year 10. What this means is that Intuit is a business that spins off cash, and right now the market is not recognizing the value of that cash into the investor's pocket. As you can see with the upside they have on the bear case, mind you, at 10.25%. That in large part is helped by the dividend discount model. Intuit does pay a very nice and growing dividend. Their dividend grew by almost 16% from last year, and I'm projecting anywhere from 13 to 15% dividend growth. And then when comparing to their peers, they have a multiple price of $790.53. And then, of course, the weighting that I talked about earlier. I weight 25% for the bear, 50 for the base, and 25% in bull. That ultimately gives me my buy price here, $749.15 for Intuit. And that's without any margin of safety. But we have to apply that margin of safety. We have to buy at a good value. And with a 20% margin of safety, that's where I get my $600 buy price for Intuit. Applied Materials is next, and I did just do a video on Applied Materials earlier in the week. They took a bit of a tumble after their earnings. Despite decent growth given their issues in China, I do have a 20% margin of safety for Applied Materials, and right now they're trading at $171.98. My buy price is at $190. So there's about 10.5% of wiggle room there for Applied Materials. There's a long runway of growth for Applied Materials given their importance in fabricating the equipment necessary to build out all the data infrastructure and AI infrastructure the world seems to be demanding. Next, we have KLAC. Now, I do not own any KLAC. I would not call this a direct competitor to Applied Materials. However, they are in the semiconductor equipment space. They are considered the niche market leader in process control and inspection of semiconductor components. I'm not going to pretend to know all the details, but what we care about is what kind of cash they'll spin off as a business going forward. I also have a 20% margin of safety for KLAC, and at a price of $754.30, I do think they're trading at a bit of a premium right now. I'm willing to buy into KLAC at $670. They would have to fall by almost 12% before I consider adding them to my portfolio. And to give you context there, I'm assuming revenue growth of about 9.5% on my base case with a free cash flow margin at just over 35% by year 10 on the base case. Right now they have a free cash flow margin of 31%. Fortinet, another top stock in my opinion, one of the leaders in cybersecurity. I have a 20% margin of safety for Fortinet. And while they're trading at all-time highs earlier in the week, scraping upwards of $114.82, my buy price is a little bit lower than that at $90. They did give a little bit of that back earlier in the week, meaning they'd have to come down almost 20% before I would consider buying more Fortinet. However, I believe they are a very good business. Cadence Design Systems, another stock I do not own, another stock part of the semiconductor ecospace, and another stock I would love to own. I do have a 10% margin of safety. They grow incredibly consistently and predictably, but at $258.34, I do think they're a bit high. I would be willing to buy into them at about $205. So they would have to come down over 20% before I consider adding them to my portfolio. But I do think they're a very good business once I would be invested. However, I think they're trading at a very high premium right now. MSCI, another business that grows like clockwork at over 10% a year. They dominate the indexing and investment portfolio benchmarking business, especially internationally. I have a 10% margin of safety for them, and they're trading at $578.34. They've demonstrated remarkable growth in the last few earnings. So my buy price is now at $540. Meaning they would have to come down almost 7% before adding more to my portfolio. And this is a stock that I would absolutely add more to my portfolio if I get the chance. And finally, I have FICO, or Fair Isaac, a stock I do not own, a stock that I've wanted to own for a while, a stock that honestly I probably could have owned last year or the year before. And like I'm about to show you now, I thought they were too high then, yet they've been dominating in the stock market. FICO has a 3-year annualized return of 51.8%. And now with a share price of $1,698.11, they're trading at quite the premium. They have a PE right now of 77.9. My buy price is at $1,475. So they have a ways to come down, almost 15% before I would add them to my portfolio. And year to date, they're already down 14.7%. Could they come down to $14.75? Absolutely. Their 52-week low is $1,105.65. So the bit more volatility that we're seeing in the market is very possible that they, as well as some of the others on this list, can come down to reasonable, fair prices that quality investors would be willing to buy into. So this is the list I have of what I believe are some of the best businesses in the world to own and at which price I would be willing to buy into those businesses. Please let me know what you think of this list, as well as letting me know what you believe about other stocks out there and what you think would be good price targets to buy into those businesses. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.